Good morning, everybody, and thank you very much for joining us this morning. This talk was originally just going to be for the Veritas Wealth clients, and suddenly we sent the invitation out to the Financial Planning Institute of South Africa, and now we have literally hundreds of financial planners from all around the country joining us today, and you're very welcome. My name is Barry O'Mahony. I'm a Certified Financial Planner Professional, or CFP, from Veritas Wealth in Cape Town. And I suppose, like many of the financial planners who are on the call today, over the last couple of years, we, in our reviews with our clients, are getting asked about crypto or about Bitcoin in particular. And often, probably 90% of the time, clients are nervously asking us at the start of the meeting, so is today the day we're going to buy Bitcoin? And then we would try and give a good answer to that, and then carry on with our financial planning meeting. But as the years have gone on, we are realizing that we as financial planners need to understand this subject a bit better and a bit deeper. And so what we did is we went out to try and find somebody or people that we could go and talk to that would have some experience in it. And it just so happens that one of my friends, a very old friend of mine, Hugo, has been involved in the industry professionally since around, I think, 2017. So I've sat down with Hugo. We've had some very, very interesting talks, way wider and broader than I actually initially thought the conversation was going to go. And that's where we came up with this idea of actually hosting a webinar. Just a couple of rules. We made up our own rules for today. If you're coming to this webinar, we would ask you to come in with an inquisitive mind, not with your mind made up already. The second thing is we all have to recognize that this is a hugely divisive subject, and often split across generations. So we would ask people just to relax your shoulders, relax your necks, and allow some new information to come in. And then two kind of admin rule or things that I need to tell you about. We're not going to have a questions and answers. Many people, probably 30% of the people who are on the call, have already submitted questions, and we have included those. We've woven those into the conversation that we're going to have. And a new poppy rule that I didn't know about is this session is going to be recorded, and I need to tell you all that it's going to be recorded, and it will be placed on the internet. So probably on the Veritas Wealth website, and also I'm sure the FPI are going to post it on their website as well. So Hugo, thank you very much for coming. Even more, he is my mate, so I can mess with him and say thanks for having a haircut and a shave. It's good to see you. So Hugo, probably the best way of going about this is just to say, like, how did you get into crypto or cryptocurrencies? What's your journey been?
Okay, well, before I start off with that, Barry, I agree with Barry. It is very divisive whenever you speak to people about it. You know, everybody seems to have an opinion about crypto. People that don't know seem to have an opinion, people who know. And then you get almost the crypto evangelists, people almost trying to force a new world order down your throat. And I don't feel I'm any of that. I'm actually quite agnostic. I'm coming at it purely from an investment perspective. And I suppose that's exactly how I got into crypto. I looked at this in 2016. I come from a trading background. That's what I do. And I looked at this and I said, look, this is very interesting. Let me just get a slide up. I'm not going to have too many slides, but it's, here we go. Let's just share that.
So you're a trader for yourself, or?
Yes, I was at Coronation Capital. I was a prop trader on the banks, for the desk at the banks in the UK, and eventually started doing this myself.
Okay.
And I thought, look, this is really interesting. It's kind of got all the qualities of a very attractive trade for one, and also as an investment. I see it more as a call option because I know what my downside risk is, and it is risky, and my downside risk is always going to be capital loss. And I'll accept that, and let's go. how do you go forward there?
Yeah. Yeah.
Okay, so it's
Not happening. There we go. Sorry, there's a delay.
And I like the asymmetric return profile. I knew there could be really outsized performances, and I know what my loss is. It's going to be uncorrelated. And from that perspective, I thought, oh, this is quite interesting. Let's just go in really small into this without even understanding the tech. Just kind of went blindly into it, and it basically grew from there. And I started understanding it more and more. And what I also found interesting is that I saw lots of similarities between this and .com. I mean, I was around when that whole .com boom was, and it had this very similar feel to it. You know, there was the euphoria, there were the naysayers, there were the Luddites, and it's got a very similar feel to this. And you know, if I look at the internet, for instance, in 1995, and people said to me, where do you see this being in 20 years? I think we would have all underestimated the human ingenuity in where the internet has gone. And I almost feel crypto could be in the same, you know, it's the same kind of, I don't like using disruptive tech, but it's a hackneyed term, but this is disruptive tech. And similarly, mobile phones, you know, when we first were introduced to mobile phones, we thought it's going to be all voice. And if you look at a mobile phone now, it's probably only 2 or 3% of the functionality is voice. Social media is another tech that came through, and it's gone far further than we thought that it would ever be. And it takes 5 to 10 years for this tech to find use cases. And that's, I found quite interesting about crypto, because I saw this is a very, very well-funded industry with some bright talent entering this industry. And I think we could see a lot of use cases coming into this in the next 5 to 10 years.
Okay, so let's just go back over a couple of things there. So from a risk basis, you say it's very risky, and when you put your money in, you could lose all of your capital potentially.
Well, that's the way I see it, you know, but you know, you need to view it holistically. What does this look like in a portfolio? In isolation, yes, it's very risky, you lose all your capital, but if it's 1 or 2% of the portfolio, well, then that's 1 or 2% of the portfolio. So
okay, and I really enjoy your analogy around the internet. And back in whenever it was, 97 or whatever, we were sitting in front of that old computer and trying to work out, so how do you expose yourself to this technology? You know, Internet Explorer was owned, I think, by Microsoft. So did we buy Microsoft? But now we're sitting back kind of going, how else can I expose myself to this?
Yes, and exactly. And all people know about is Bitcoin and I suppose Ethereum and so on. And that, I suppose, is the next question. What is crypto? Crypto isn't Bitcoin.
Sorry, that's my job. I'm asking the question.
Oh, sorry.
There we are.
Okay, so crypto, it's a generic term. It's everybody, you know, it's not Bitcoin, it's not Ethereum. There are multiple asset classes within crypto, and often gets quite confusing. But you know, just investing or just having exposure to a single one of these is kind of having exposure just to one asset class in the multiple asset classes one has got. So I'll get into the different asset classes within crypto a bit later, yeah. But it's important to understand that it's generic. It's not just one thing. There are multiple facets to this. You know, people mostly see this as just a currency.
Yeah. But
this isn't just a currency. There are many, many facets to this. And it's also because it has been dominated by really just two cryptos, that being Bitcoin and Ethereum. And as you can see from that graph, that is majority of the market cap has been Bitcoin and Ethereum. And the smaller coins, they call them altcoins, and they're starting to come through now. And it's quite interesting to know that there are about 4,000 different cryptos, and about 100 of them have got a market cap of over $100 million. So there are a lot of them around. Okay. And there are only very few currencies around. Only about 7 of them are actual cryptocurrencies. Okay. So we shouldn't get Bitcoin confused with crypto. Crypto is more of a generic term. Okay. And they actually all share similar characteristics. And that is they're on the blockchain. I'll explain exactly what the blockchain is. Something called a distributed network. There are miners involved, they're digital wallets. So it gets quite confusing. There's a lot of tech terminology thrown around, but they share similar characteristics. And I'll try and very simply explain what those are.
Yeah, because one of our goals today is to try and explain this as simply as possible, stay away from the jargon and not go down the rabbit hole of the tech. So surely it's risky to invest in an asset class with so many unknowns, Hugo.
I do think it's very risky. And I suppose it's at what point do you want to get exposure to this asset class? You can get it right in the beginning. And again, I'm going to use the .com analogy. And, if you had got into .com early on, you would have had a far higher performance, but there would have been far, far higher volatility. And I think we are really kind of the 1995 stages or 2000 stages of where the internet is. So yes, it certainly is risky, but I still come back to that basic tenet is I know what my downside is and I know what the upside is. And the upside could be multiple of 20, 30 times capital. And that for me is really attractive. So yeah, it is risky, but if you see where we're getting into it, I mean, I've just compared market cap sizes of the tech stocks, basically NASDAQ, compared it to crypto. And as you can see, it's still a very, very tiny margin of that. I mean, right now it's got a market cap of about 1.5 trillion, where NASDAQ's about a 20 trillion market cap. Oh, so there's still huge potential for growth. So it's also interesting to see when you look at the .com, what it looked like in 2000 versus 2021. The different colors represent different asset classes within NASDAQ, and you can see how that has changed. Yeah. And I think it's going to be exactly the same. A lot of those stocks in NASDAQ, we won't even recognize the names. Things like Napster and Netscape, they aren't around anymore. And probably something similar will happen with crypto. Okay. I think the landscape is still going to change. We're still at the nascent stages of it.
Okay. So now sometime last year, the Bitcoin went from 10,000 and reached like 60,000. I know it's come off quite heavily in the last couple of months. But what was driving that surge?
Okay, well, let's just first take it back to 2017. Before that, there wasn't large scale of adoption. It was really only Bitcoin. I think Ethereum only came around 2013. Bitcoin's been around since 2009, and there wasn't growth. And then I think the retail market got wind of it, and there was a massive push of money into this, especially into Bitcoin, not so much the altcoins in 2017. And then the regulators woke up and they started regulating it. China started banning exchanges. So there was a lot of movement and it became a lot bigger. And then we went through crypto winter for about 2 years. It didn't do much. And there was a lot of money waiting you could see there was a lot of money waiting to enter the market, and that was mainly institutional money. So the last push has really been institutional money. But this is still speculative money chasing it. It's the same as .com, what happened in 2000. It was first investors speculating, and then after that, the use cases started coming. So the use cases are coming, but they're still not there. There's not a large, wide-scale adoption of use cases, and that's real-world application of crypto and blockchain to solve real-world problems. It is being done, but it's not in large scale yet. So
people that are buying it at the moment are buying it to get a capital growth in it rather than to actually buy a Tesla car or something like that.
Exactly, 100%. This is speculative money, and you can see it. We can see it from the people that are buying it. It's open source, so you can see the wallets, and people are just holding on to their investments. Okay. So there's a lot of investment speculation in this now.
Okay, so do you see it as a good investment, Bitcoin or crypto?
Yes, well, I've got it in my portfolio, and yes, I certainly see it. And I still think it's got a It's got a lot of growth for investment. So we know what the downside is, but you also need to look at the upside and say, look, it's run hard. How much upside is there? And it's quite interesting. If we were to see, it's difficult to define Bitcoin, for instance. I'm using Bitcoin here as an example. Is a store of value? I don't think so. How can something be a store of value that loses 50% in 3 or 4 weeks? But it certainly is a medium of exchange. But if you see it as a store of value, and those dots are representative of the size, it's tiny. It's only 0.7 trillion, where NASDAQ is 20 trillion, M1 money supply 7 trillion, M2 money supply 40 trillion. So these are still huge. So if it ever is seen as a store of value, it's still got a long way to go before it becomes really relevant. Okay. And I suppose gold at 12 trillion is also it's a store of value. It's only a fraction of that. But if you look at it as a medium of exchange, it's quite interesting. I mean, there's 35 billion gets traded daily on Bitcoin on average. I mean, it's a big number. And on crypto, it's about 120 billion gets traded per day. But if you contextualize it and you look at it relative to SWIFT, which is the international banking money platform, that's 5 trillion a day. That's 35 million transactions. So it's still got a long, long way to grow. So there is massive potential for growth in there. And from that perspective, if you want to get in early, I still see it. I mean, it is risky, but yeah, I still see massive potential for growth.
Okay, so let's go into now understanding some of the concepts, some of the terminology that's used around crypto, and so blockchain, cryptocurrencies, tokens, miners, all of these things. So let's slow it down a little bit and let's try and help the layman or the CFPs out there to understand it a little bit better.
Okay. All right, so firstly, the most common thread between all the cryptos is they use something called blockchain. Okay, now blockchain is basically a database. It's how, and all databases are structured in a certain way, and it's how this database is structured. And the way this is done, whenever there is a chronological order to data in a database, you can store it using blockchain technology. And that is, you can choose any time frame you want. If we use Bitcoin, they use 10-minute time frames. So what happens in 10 minutes creates a block. All right, so all the transactions that happen in 10 minutes, there's a ledger that's created, a set of accounts effectively, all right, and it looks at that ledger and then all the computers, I'll get to that, how that happens, but that ledger gets balanced. And once there's an agreement to that ledger, it becomes a block. And that cannot change. It becomes immutable. That means it's difficult to change. And once that block occurs, that's your first block. Then the next 10 minutes comes along and we look at the next, but you can't get to the next block unless that first block has been solved and everything balances.
Okay.
So there's a chronological order to things. And that's why it's such a safe way of storing data, because you cannot, you cannot change anything unless you change all the previous blocks, and there's not sufficient computational power to do that. So it's a very safe way of storing chronological data.
Okay.
And transactions is chronological. If I give you 1 Bitcoin, only at that point that you've got 1 Bitcoin can you give it to somebody else.
Okay.
So it takes account of that.
So everyone's checking that you gave it to me and now I've got it and now I can do something else. And that's what's going around between all these different computers.
Exactly. That brings us to the next characteristic that all cryptos share. And that is, how does this data get stored? The normal banking system does it in a centralized way. So there's one depository for all this data. But with crypto, it's done in a trustless system. So nobody owns it. It's done in a distributed way. So there are multiple computers that store the entire blockchain. Okay. And that's let's use Bitcoin again as an example. There are 17,000 nodes or 17,000 computers that store the entire blockchain. And they check this every single 10 minutes. And once that's completed, then all 17,000 computers go on to the next blockchain.
Okay.
And nobody owns this. So it's called it's a trustless system. We don't need to trust any single person.
Okay. So is this like an individual geek sitting somewhere with a laptop? I mean, is that the level of computing power you're talking about?
Well, it started like that. You know, there were people that were, and these are called miners, the people that the computers that sit on the nodes, these are miners. So they are mining. I'll get to that. They are basically mining for Bitcoin.
Right.
And there needs to be some reward system. You say, why would I want to balance this ledger or complete a block every 10 minutes? Again, I'm using Bitcoin as an example.
Yeah.
It says, well, because there's a reward for it. And for Bitcoin, you get 6.25 Bitcoins every 10 minutes. So if you complete the block first, you get rewarded with Bitcoin. So it incentivizes a whole lot of people to sit and create this distributed network. And anybody can join. So it used to be with laptops, but laptops now don't have enough power.
Yeah.
So you're dealing with large warehouses of miners, and these are specially designed computers that actually mine.
Wow.
And
that's where the electricity problem comes into play now.
Exactly. That's where the electricity problem. And that's, again, for Bitcoin. It's very electricity intensive, but you get different networks. There's Ethereum, which works on a completely different network, and that's got about 10,000 nodes. And then you get Cardano, and they are different networks. Okay. And then the other attribute or characteristics are digital wallets. And a digital wallet is nothing too complicated in concept. It's basically, instead of storing, you don't necessarily just need to store currency, but you can store data, you can store anything. It's in a very secure place. And these are called digital wallets. And that's where the word crypto comes from, because they use cryptography to get into and out of the wallet so that it's secure. So blockchain's been around for decades, distributed ledger's been around for a while, but the trick that they had to get right was the cryptography on how to get data or coins in and out of the wallet.
Okay.
And when they solved that, that's basically when they launched Bitcoin in 2009. And, you know, we hear of hacks, we hear of a lot of things. But, you know, these are inefficiencies within the system, but the wallets themselves are very, very secure. It's not possible. It's been very difficult to actually hack into wallets that are off. They call them cold wallets, and that's when a wallet is not connected to the internet. There's been no known case of any wallet being hacked that's been off a cold wallet that's been off the internet. Okay. So there are very safe and secure ways of storing.
Okay. And so tell us about other concepts that are, what is a token?
Okay. As I said earlier on, crypto is a generic term for multiple different assets within the whole crypto ecosystem.
So in other words, currency is just one thing.
Currency is one. And a currency is where you have your network. And there's a native currency that runs on that. Mm. And Bitcoin is one. That's very simple. The next largest is Ethereum. And Ethereum is different to Bitcoin. It doesn't just store the ledger of your accounts.
Right.
It stores something called a smart contract. And a smart contract is any set of rules that you can put in place. For instance, I want to give Barry Bitcoin, 1 Bitcoin, but I only want to do it. I can put any arbitrary rule in. If the temperature in the next 20 days is above 15 degrees, I can put that in. And if that is, then that transaction will happen. So that's a smart contract, okay? And then you get different networks that have different attributes. For instance, Bitcoin is quite a slow network. It was the first network. It can do between 5 and 8 transactions per second. You're getting networks now that can do 10,000 transactions per second. Bitcoin, for instance, is very energy intensive. You get other networks that aren't energy intensive. So that's just the currencies. And there aren't many currencies. I think probably about 7, 8, 9 currencies.
Okay.
Ethereum is a currency or not. It's got its own, but it's also a protocol.
Okay.
So a lot of the cryptos actually run on the Ethereum network. Okay. And these are called tokens. So these aren't currencies. These are crypto tokens. So they piggyback on another network, and they've got different attributes. So another asset class in this is, for instance, stable coins. And stable coins or stable tokens, a coin is interchangeable for token, is where they are linked to an asset. So it's asset backed. So it could be linked to diamonds, it could be linked to steel. There are ones that are linked to gold, to the US dollar, like USDT, US Tether. It's linked, so it's a one-to-one backing to gold. These are stable coins, which again is a different asset class. You can also get utility tokens. So they have something different. It's not a medium of exchange. It's not a currency, but it's almost like a custodial service. So for instance, where you need a chronological database is, you can look at title deeds for houses, for instance.
Yeah.
So when you've got a title deed, it can get stored on the blockchain. And the blockchain, and there are some of these tokens, that's what they do. So it's a utility token.
Yeah.
Because you never want that to change. Once you have owned a house, you need a record of that, and then that ownership gets transferred. So that's not a store of value. It's basically a store of data.
Okay.
So the blockchain can be used for that as well. Another good example, and there's an interesting token out there called Civic, and they store personal identities.
Oh, wow.
Okay, so and basically you can put your DNA on the blockchain, you can put your iris scans, fingerprints, and that will never change. So I think you're getting a feel for that there are multiple asset classes.
And what's the is it what's that?
NFT.
NFT, yeah.
Yes.
What's that?
It's actually quite an interesting asset class. It stands for non-fungible token.
Yeah.
So for instance, Bitcoin, Ethereum, these are fungible. They're all the same. One Bitcoin looks exactly like another Bitcoin. They are identical, fungible. Non-fungible means that they are non-identical. And that is for storing digital art. So it's not art that we hang on the walls, but digital art that can be stored in a, let's just say, JPEG format, and that gets stored on the token. And that is how ownership is. And you can share that ownership, and royalties get paid when somebody else uses that art. And these are NFTs. And they're actually doing quite interesting things. They are storing, tweets. They're quite unusual things that they are stored. There's also collectors' cards that they're storing on there. So you can almost store anything there.
Oh, wow. So I mean, this is quite interesting for financial planning in the industry that we're in. Is one, your FICA, you're talking about CITIC. So we could store all of somebody's, but I mean, you could go down to DNA and that sort of stuff as well and put it in there. So when a financial institution needs it, you can allow them access to seeing that because it's not changeable. The title deeds office sounds as if it could be, the employees there could be in trouble, because what do we need that for? I'm giving you the title deed and here's the record of it. The other one about the art is that's fascinating, because you often hear musicians and stuff complaining that these platforms have actually taken, I mean, their income has been crushed. Whereas now actually it can be recorded and it's easily seen how many people have actually used it. Yeah. So, I mean, so this is what you're talking about being used. This is use in the real world now.
Correct. Yes. These are still innovative concepts. There's not large scale adoption. I think NFT is starting, there's quite a bit of adoption on there, but we're not still seeing massive large scale adoption on this. And there are certain reasons for this. I mean, you're basically hit up against traditional industry that don't want this because it is quite disruptive. So,
yeah, because in our industry, again, the other one that always strikes me with currencies is around Forex. If we're taking money out, the banks are clipping it by a few percent between the buy and the sell. I mean, this technology would, basically nearly take them out.
Oh, exactly. It's an instant medium of exchange. Once you work on it, the first time you do a transaction on the network, it's actually amazing. You put it in and you realize there's 17,000 computers working in the background, making sure that your transaction is going to go through. And you look on your computer, and a few minutes later, there it is. It comes through. It's actually quite rewarding, and you start trusting it a lot more than the banking system once you start using it. So
okay,
yes.
so this is a big learning for me. Is like it's not just about Bitcoin and currencies here. That is a major part of it for the moment, but actually the opportunities are kind of endless, broad and wide. And
exactly.
Okay.
Yes, no, I'd agree with that.
So Hugo, just go back to some people who are asking this and the questions and answers. Is crypto a store of value?
Well, there's certain cryptos that are store of value. There's the asset-backed securities that are store of value. I mean, I can't see Bitcoin being a store of value. It's too volatile.
Right.
I suppose as it grows, the volatility will go out. But it's not a store of value. But yeah, it's difficult to define. But the asset-backs certainly are store of value.
Okay. And I suppose if people are only buying it to get a capital appreciation and it's not being used functionally, then it will stay as volatile as it is.
Yeah, correct. Yes.
Okay. And how do you value crypto?
That's always the question that comes up. In traditional finance, we're always used to valuing things from a discounted cash flow. If it doesn't have a cash flow, how do you value it? And I agree. Some of the cryptos are very difficult to value. There are cryptos that actually do have cash flows. They'll be easier. And but yeah, I agree. It is difficult to value, but it's easy to value the entire market. I mean, let's take out Bitcoin and Ethereum, the two dominant ones, and you look at all the other altcoins, the smaller cryptos, and you look at that, and that's probably about 300, that changes from day to day, 300, 350 billion. That's the size of it. And for me, that's still very, very small compared to the NASDAQ, that's 20 trillion. Right. So if I look at the entire market, I can value it and say there's still a lot of growth. But to value individual cryptos it's very difficult.
Okay. I would say a mug scam. Okay. So some people call it a Ponzi scheme. You know, the naysayers call it a Ponzi scheme and kind of wave it away. What's your view on that?
Well, in a typical Ponzi scheme, you get rewarded for entering into that system, being part of it. There is no reward for getting other people onto it, into the ecosystem. Okay. So I don't see it as a Ponzi scheme as such. You know, okay.
Okay. So the only thing is the early adopters may have done well in a Ponzi scheme if they got out.
That's right.
But if they hadn't, okay. So this really brings us down to, so what do you see as the main risks in crypto and investing in crypto or in crypto?
I do see, look, we're not blind. I'm an investor. I see risks. You know, we hear all the scam artists and, you know, there's a lot of theft. There's a lot of hacking going on. But besides that, there are some real systemic risks. The one risk that we had a good look at was the regulators. Okay. And that was in 2017. We didn't know which way the regulators were going to go. And we must be clear what the regulators are there for. The regulators are there to protect investors.
Okay, so let's just slow this down. So to bring everyone, because what is a regulator? In America, it's the SEC.
That's the SEC.
FSCA in the UK.
The FCA.
FCA.
Yes.
And FSCA in South Africa.
Yeah, and FINMA in Switzerland.
Okay, so what are they saying in general?
Well, look, we've spoken to them, and what they are saying is they are supportive of this. They are supportive of anything that will bring liquidity to the market.
Okay.
But they want to regulate it. They want to regulate how people get into this. And you can see they've actually done a really good job. Before you get onto an exchange via fiat, in other words, hard currency, it's regulated. Your standard AML, KYC, before you get onto the ecosystem, and that you do via exchanges. So in Europe, in Switzerland, they actually are regulating that very well. And
So a regulator's job, maybe just to say that, what is a regulator's job?
A regulator's job is to protect investors.
Right.
A regulator's job is not to protect economies. That's what the central banks are there for.
Okay.
So I see that as a risk. Central banks still haven't spoken up. We don't know what they're going to do. Generally, when you see what the Fed's saying, say, look, we are supportive of competitive currencies, but it's still small. So we don't know, once there's tax erosion, once there's certain the implications to this, but now we're speaking about more the currency side of crypto. There are a lot of other, there are a lot of asset classes that are unaffected by central banks. Or,
Okay, so we are talking about cryptocurrencies in this conversation.
That's the currencies, yes.
So just slow that down around central banks or the Reserve Bank in South Africa. They're worried. So their fear is what? Is there a political fear, an economic fear?
Well, yeah, I suppose there is a tax erosion fear.
Okay.
So there is that risk, and I don't know how the central banks will deal with it, but at some point I think they will need to address, and that point's coming quite soon. And I do see that as a systemic risk to all cryptos. The other risk that I see is a network failure. It's quite amazing. Bitcoin's been around for the longest, 12 years now, that every 10 minutes that network has worked. It has never failed. It's actually quite a remarkable feat. For the first, it's complicated tech that has come on that there has been no failure. And we one catastrophe away from a failure. If there's a major network failure or major network hack, I think it will affect all cryptos. It is a real risk to that. So I do see that as a risk. There's also use case adoption. There's a lot of headwind to these use cases, and we need to see real world adoption in a larger scale. So that's where I really see the growth. The speculative money that comes in here, this is silly money, driving prices up on weird supply demand.
Right.
But once the use case is in, there is real supply and demand mechanics at play, and that will be the next push in crypto, and that's probably a few years away, I'd say.
So let's just go back to you've mentioned a few times like how amazing this tech is, and I'm talking about cryptocurrency now, how safe it is. And today, and a couple of months ago in South Africa, and now today, there's quite a spectacular headlines about AfriCrypt and the 17-year-old and the 20-year-old who are running it have disappeared, and apparently 51 billion rand with them. So when you say it's safe, like how has something like that happened? Like, what's the difference there? How does the ecology work?
I suppose it's how do you get into this? You need to, if you give your money to somebody, they control where the private, the wallet, the digital wallet. Once somebody's in control of that, they have full access to your funds, and that's what happened in this case. There were, I think, 69,000 Bitcoin. So they all invested in Bitcoin. There was no regulator involved. There was nobody double checking. You need multiple people looking at to see where it is. To have one entity having full control of a wallet is always a dangerous.
Okay, so the whole idea was you were attracted to the decentralization of this whole thing and people checking it, but you actually have to get onto those train tracks. And your danger now is at the train station and who's there.
Correct, yeah.
Okay.
There's also some risk that people speak about are energy. We hear that a lot.
Yeah.
And I really don't see that as a risk. For Bitcoin, yes, it uses a lot of energy. They never envisioned this to be this big, I think, So these miners have become so large that they consume so much energy. But Bitcoin is a singular case in that it does use a lot of energy.
Right.
But Ethereum, so they're going onto different ways, techniques of mining. I don't want to get too complex about this, but it's something called proof of stake. So you need to put up collateral before you get the right to mine. Therefore, you need a lot fewer nodes. It uses a lot less electricity. So, and a lot of the electricity used actually here is renewable. So I think they will sort that out probably in the short term. We've already seen it be sorted out after Musk's comments. So okay. I don't see that as a real risk. They will find solutions to that.
Okay, so from an investment point of view, like how much would you expose to something like this?
Yeah, it's a good question. As I said, there are a lot of headwinds to crypto. Intuitively, I'm saying 2-3% of a portfolio should be in this. You might say it's completely irrelevant, but because the upside returns have been so outsized, we're not used to this in traditional markets. We used to, a great return is 40% per annum. Here we're getting 1,000, 2,000% per annum. Mm. So just to have a very small allocation is significant. However, once you put this in quant models, it shows a lot higher allocation because of the uncorrelated nature of this. Okay, but still intuitively, I'd stick with a very low number. This is just a very simple graph, just showing. I haven't done it by not rebalancing because it's just the returns look ludicrous. But if you rebalance at the end of every year, just down to 2%, and that was in Bitcoin. This is what the returns would have been like. It would have been, that's comparing to the S&P, which has had phenomenal returns in the last 10 years. And that just kind of shows what a 2% allocation to Bitcoin would have done to the portfolio. So I would kind of stick around about there. I think that's quite a prudent approach.
So the way you're speaking about this, you're talking about taking profits off the table all of the time. You're talking about diversifying within this. Do you know what I mean? You've introduced a whole lot of new, not that you've introduced it, but today's conversation, there are lots of different ways, different things that you could expose yourself to.
Yeah, Barry, that's a whole other conversation. I mean, one is to recognize that there's probably some value in having a little bit of crypto in a multi-asset portfolio. And then the other one is, how do you do that? There are scams, there are different ways of doing it. And that's a whole other discussion. Do you go for a broad-based approach where you get as many of the asset classes? Do you do it via a regulated fund? Do you go something that's got high beta or low beta? Yeah. So, we've looked closely at it, and I do think you go for a broad-based approach. You get as broad a base, and you need to look at the professionals who do this, because there are a lot of things that can go wrong here, especially in the storage of it. You can't lose private keys. You need to have multi-sig. In other words, multiple regulated people looking at this and having access to that, so that not one person has access to it. So there are certain,
and that's probably what's gone on today with the case of,
yes, that's right. It's two youngsters. They were entrusted with everything.
Okay.
Quite interesting also when you look at it, why you should include it in your portfolio. I mean, one thing you look at is Sharpe ratio. Sharpe ratio, for the more technical people, it's not really relevant because this thing's so asymmetric. So it's more you look at Sortino. But it's these Sharpe ratios and Sortino ratios, which means the amount of return you get relative to the risk that you take on. That's effectively what that measure shows. It's completely outsized for crypto.
Right.
So, you'd want to include it in your portfolio. And especially if you look at the investment landscape now, I mean, the efficient frontier has become concave. Normally it's convex, meaning normally as you take on more risk, you get a lot more return.
Yes.
And this is not showing in the market now. As you go up in your risk, you're not getting a lot more return.
Okay.
And crypto is giving you that.
Okay.
So you just need a really small amount.
Okay. So I just wanted to chat a little bit about in practice. A lot of us are, maybe younger clients or kids of clients are coming through and they have an exposure for the last few years in Bitcoin or crypto, and they've made a lot of money and lost a bit of it as well. And hopefully they were in earlier. I mean, what would you say in general to those people? It sounds to me like they should be taking a bit of profit and diversifying.
Now let me just go here to. Let's just look. It's been the Bitcoin show, and we can see what's happened. You know, up till 2017, when Bitcoin goes and all the other cryptos follow it, it sucks all the liquidity out the market. And then you can see Ethereum has a go, and then the altcoins have a go. And that's what happened in 2017. You know, these altcoins showed far superior returns to Bitcoin. When they all came down, they also came down a lot more. And again, now in the last bull run, we saw exactly the same happen. So I think it's good to have a diversified approach to this. I don't think it's wise having a market cap kind of approach, because again, it's dominated. Now I think it's a lot less. It's about 60% is Bitcoin and Ethereum. Even a market cap approach, you're going to get outsized concentrations to just a few, and you want to diversify across the different asset classes.
Okay.
So Bitcoin's been good. I mean, we can see those kind of 1 year rolling returns. They're ridiculous, actually. So it's been good. I'm not sure if it's going to carry on like that. You know, just from when we speak to people, there seems to be they seem to be a lot more favorable with Ethereum compared to Bitcoin. You know, but still, I'd expect a large, a broad-based approach.
So the excitement, the what do they call the crypto punks? Do they believe that? What's the argument? Is their argument that crypto or Bitcoin is going to replace like the US dollar?
Yes,
is that their belief?
Yeah, it's a lot of libertarians and so on. They're very supportive of it because it's decentralized, it's not owned by anyone. So it really appeals to that kind of psyche.
Yeah.
So yeah, definitely. And they also see that the current system is broken.
Okay.
And it's that continual narrative that the current system isn't working. But you know, a broken system can run for a long time. I'm not certainly in that camp. You know, it's
okay. Yeah. I was actually listening to a podcast recently about libertarianism, and where they're talking about let government leave control and let individuals make their own decisions, which is quite interesting when you look through COVID and see what individuals, the decisions that they've made, and when they were allowed to make them, like what the consequences have been, like in America or in Brazil. So where do you think this could be in 10 years from now?
Yeah, I see this as a binary outcome. It can't stay at the market cap where it is now. The market cap of total crypto is about 1.5 trillion.
Okay.
You know, it's either going to get decimated by regulators or central banks or something, some kind of catastrophe will come along and it's going to be worth a lot less than it is now,
right?
Or it's going to be worth a hell of a lot more, but it's not going to be 2.5 trillion. I mean, if there is adoption, this is going to be multiples of where it is now. So I do see a binary outcome. I'm not in the game of predicting.
Yeah.
So
how could a central bank take it out?
Yeah, this is speculation. These are purely my views. Absolutely. I mean, one thing they could do is they could effectively buy it out. It's not inflationary. They could buy it and destroy it. So it's not inflationary.
So they buy all the Bitcoins in the world.
No, they can buy all the crypto, but people can't carry on creating. You know? So
they don't want to drive it underground.
Yeah, that is one thing that they can do, and you can manipulate price like that. So that is something. It would be very unfavorable for the central banks. It certainly wouldn't have public support that, but that is something that could happen. And that's just, those are my personal views.
Okay. And crime, Hugo, some people believe like the underworld is in here and they're trading through this or using this through this stuff. Like what would you say about that?
No, there certainly is. I mean, there is, but there also is with dollars, cash. There is with Swiss francs. I think they've got 1,000 franc notes. So there is crime. Definitely, but it's becoming less and less so. Since the regulators got on, to get into the ecosystem, people know who's on.
Right.
So it's not anonymous anymore. It used to be anonymous. You could just jump on, get a wallet, and you didn't know who owned the wallet.
Okay.
Pre-2017.
So that's gone.
No, that's gone. Okay. Now you can't get a wallet unless people who you know. So they are pseudonymous.
Okay.
However, there are 2 or 3 coins. They're called privacy coins, and they are anonymous. So people can still hide away there, and that is where you will always get that.
Okay. Okay, great. Okay, well, we've gone for 50 minutes here. I think that was a good session. I've certainly learned a lot. So what I thought was just Bitcoin and Ethereum, I've now learned that there's a whole lot of other technology. I think that is going to become useful to us. I can see, I mean, actually, maybe another question would be around what industries do you see going to be disrupted by this?
Well, there's another asset class that I didn't mention, which is DeFi, decentralized finance, and that's the banking industry, the finance industry and the banking industry, because there's a lot of custody of information, client information, information regarding assets. So there's a lot of custody there, and a centralized custody. Okay. And I think that will probably be the first industry that will be disrupted.
Okay. So because, I mean, profitability of a bank, if the SWIFT system and that number, I can't even remember how big it was just enormous on a daily basis. And if the banking system's not making a little cut of that every day, and that went onto a different tech where that margin was shrunk, I mean, that's going to make that's big.
Yeah, it's huge. And also storage of data, you know, clearing houses and so on, you know, who owns stocks, script, and so that's all. It's just storage of data. Yeah. And I think the custody of that is under threat.
So for us in our industry, when we're using platforms, our platforms to hold unit trusts and to hold retirement annuities and all the other products, that too could move across to this sort of technology, make it more efficient, more safer. Yeah,
it's very well suited to that.
Okay. Yeah. All right. Well, Hugo, thank you. Thanks for your time. Thanks for your expertise on this. Thanks. Somebody, Jose, asked us to please be independent, and hopefully we were, and not one-sided on this. And hope you've enjoyed it. And thank you very much.
All right. Thank you very much.